Welcome to Eureka Street Crypto. This is my anti-professional crypto channel. I'm just a barely sane dude who fell down the cryptocurrency rabbit hole. This channel is my fumbling attempt to communicate myself outside my own head about my journey in the crypto space. It is basically my brain dump. None of this is actual financial advice.
Good morning, everybody. I'm Eureka John, and you're at Eureka Street Crypto, broadcasting live from Leander, Texas. It is 5:49 in the morning, and it is June 17th. Is that June 14th? Or is that Juneteenth? Or is that June 14th? I don't know, whatever. But yeah, this is my morning crypto broadcast. I know I haven't been doing it every day like I used to, but I want to get back to that. And you know why? It's because now I'm unemployed. I quit my day job working at a hose plant to follow my dream. And I got this job at a crypto morning show. And, at first it was full time. And then when the crypto market started declining, they said, hey, can you do 20 hours? I was like, okay, you know what? It's worth it. I will do that. So I jumped on with them. It has been a great experience. I've learned a lot. It's like full-fledged, broadcast studio. But then I just got news yesterday that the show got canceled, and that was what I was hired for. They'll probably hire me for other, types of stuff, because it was contract work. But at for the time being, everything is completely uncertain. So that is the crypto market right now. And I feel fortunate that I do have some savings right now to lean on while I look for some other paying gigs and jobs. But I probably wouldn't have gotten out of that hose plant that I was working at if that opportunity hadn't presented itself. So I try to look at the silver linings of all this, and I got to work in a live broadcast actual studio. It was really cool. Got to work with some really high-end equipment for my first time that I would otherwise not have access to. Now I have that experience. So, just because something might not go your way right in the immediate present or in the immediate future does not mean that things won't work out. I did this show every single day starting October 24th, 2020 for over a year. Did not miss a day. And I learned a lot about sound and video. I learned a lot about how to speak about stuff live on camera, and I learned a lot about crypto. I learned how to interview people. All those are skills, and those skills got me hired for that gig. And I have no doubt that these skills will help me get hired for other stuff. And it may have taken that little kick in the butt to get out of my little comfort zone at that stable job in the factory. I mean, however, the factory is over. It's like an hour and a half away. I was spending nowadays with gas $150 a week just to be able to get down there, and then lunch every day and stuff like that. So it's like $200 a week, or $220 a week just to go to work and back. So yeah, is this live? I hope so. Anyway, whatever, it's recording. But yeah, so a lot of stuff has been happening in the crypto market. The crypto market has like a Coinbase, not Coinbase. Was it Coinbase? No. Who was it? Coinbase has laid off like 1,600 people. Was it? Yeah, Coinbase has laid off 1,600 people. And I think they were up to 4,000 or 5,000 employees, but they overhired, and people working in the crypto space. Okay, I believe in this stuff. I really am in it for the tech. It's why I'm back on my computer doing this stuff now, even though everything's in the toilet. What, Bitcoin's at 20,000 right now? I don't even know what Ethereum is. I guess I could switch over here. I will take a quick look at the chart. So let's go over here to the charts, and let's see what. So I'm going to talk about hypothecation in a little bit. But in the meantime, let's take a look at the crypto charts and see what's going on. If I can get it to pull up. because it's live streaming. But yeah, so Coinbase overhired. BlockFi's cutting its staff. A lot of these crypto projects are cutting back on their staff, including the company that I started to work for. They, cut the show. Crypto's down. They're a mining company. That's what they depend on. And right now, their revenues have been chopped down by half. And miners right now are going for super cheap. So if you're looking to get into ASIC mining, now might be a good time to do it. So, yeah, if you're looking to get into mining and you want to buy an ASIC, now is like a really good time to do it. There's a company called CleanSpark that just bought like 2,000 miners, and miners are expensive. They can range from $4,000 to $25,000, $30,000, and they just bought about 2,000 miners. So, they're using almost in a way miners as the asset. You can flip miners. You can buy them for cheap during the dips, and then you can sell them for expensive. It's the whole idea of just, buying cheap, sell high. Buy low, sell high. It's the cardinal rule of doing business, and it's how you do business. And too bad I haven't really mastered that trick, but working on it, But okay, so let's go over here to CoinGecko and take a quick look. I'm not gonna, I'm not your TA guy and your price analysis, your technical analysis guy. I don't look at graphs or anything like that. But I'll look at the price right now. So Bitcoin's at $21,017.53. Ethereum's at $1,098.88. I think it's all gonna go lower, honestly. Everything is kind of in this death spiral right now. Of course, all that Terra stuff triggered it off, and then some of these centralized finance platforms are having their own issues. There's been all these layoffs that I was talking about, and everything is just feeding on each other in this death spiral. But I believe that crypto and decentralized finance and things like that, Bitcoin, I believe it's freedom, and we can't forget the overarching principle. We are in a financial war right now. The SEC and the banking institutions, they do not like crypto, and they are doing everything in their power to fight against it. The Fed rate hike right now, they printed money and they printed money and printed money all last year. Now they did a rate hike of 75 basis points. 75, yeah, so that's a lot, and they'll probably do other ones, 50 to 75, maybe even 100 basis points. And when that interest rate goes up, people have to a lot of times pay back their loans, and they don't know where they're going to get the money. They need liquidity, and it just causes a lot of pain whenever the Fed tries to correct the inflation. Now, there's no way this inflation will be corrected. And then you're talking, I'm saying this, and I don't understand jack squat about the economy and how this works, but I have been able to figure out this much. Anyway, so let's talk about what I was going to talk about today. I was going to talk about Celsius, but in order to talk about Celsius, we kind of have to understand what hypothecation is. So hypothecation and rehypothecation are the words for today, right? So, hey, what's the word for today? Hypothecation and rehypothecation. Okay, so that's two words for today. So hypothecation is when you agree to give a certain asset in exchange for a loan. Secured loans, including auto loans and mortgages, they require collateral. If you default on your loan, a lender can use that collateral to pay for the outstanding balance. When that happens, the asset is hypothecated. Even in your pawn shop, if you hawk your guitar, that's your collateral. You are hypothecating your guitar. And if you don't pay back that $50 that you hawked up your guitar to get, then they will take your guitar, your Gibson or your Martin or your Fender, whatever it is, and it's theirs now. So that's hypothecation. So rehypothecation is, say that pawn shop wants to borrow some money themselves. So they take your guitar that you put on hawk, and then they put that guitar on hawk somewhere else. And that is a common practice. So rehypothecation is a practice whereby banks and brokers use for their own purposes assets that have been posted as collateral by their clients.
Clients who permit rehypothecation of their collateral may be compensated either through a lower cost of borrowing or a rebate on fees. In a typical example of rehypothecation, securities have been posted with prime brokerage as collateral by a hedge fund are used by the brokerage to back its own transactions and trades. So this rehypothecation was a common practice until 2007, but hedge funds became much more wary about it in the wake of the Lehman Brothers collapse and subsequent credit crunch of 2008 and 2009. In the United States, the rehypothecation of collateral by broker-dealers is limited to 140% of the loan amount to a client under Rule 15C3-3 of the SEC. Rehypothecation occurs when a lender uses an asset supplied as a collateral on a debt by a borrower and applies its own value to cover its own obligations. In order to do so, the lender may have access to a variety of assets, promises, collateral, including tangible assets and other various securities. So what does all this mean? Well, Bankless did a little newsletter about this whole Celsius issue and the hypothecation and what exactly was causing a lot of this. And it has to do with the staked ether. But before I get there, I want to talk about this article that Altcoin Buzz that I think so far explained some of this stuff the best to the layperson like you and I. So I'll get into some of the points here. Celsius Network, game over for Cell. Celsius Network is a peer-to-peer lending platform allowing users to borrow and lend cryptocurrencies. The system is based on the Celsius Network native token CEL. CEL is the ticker. Okay, so there's a difference between DeFi and CeFi. DeFi is decentralized finance, and that allows you to take your crypto, like your Bitcoin or your Ethereum or whatever, and to go to a platform like Maker or Aave or Yearn Finance or something like that, and to lock up your crypto as collateral and borrow against it. So that way, I mean, you could do something like if you need some cash for a down payment for a car, if you just want to buy a used car, you could lock up your crypto so you don't have to lose your savings and buy some investment. So what you can do is lock up your savings, borrow against it, and buy that used car, because you have that crypto locked up in collateral, and you can see it because you did it through your wallet, and you made the transfer yourself. You can see it all on the blockchain. That's decentralized finance, and you've gotten some Ethereum in exchange for locking that up. You changed that Ethereum over to USDC stablecoin pegged to $1, and then you sent that to an exchange. You cashed it out for US dollars, and then you transferred it to your bank, and then you used that money to buy that car. And then slowly over time, with a very small interest rate on that DeFi platform, you can pay that back, and then you can unlock your collateral. And I did that. I've done that on a couple of occasions using Aave and using a couple other DeFi platforms. But the thing is a lot of people have been over leveraging themselves. Like they lock up their crypto, they borrow against it, then they lock what they borrowed up against somewhere else to earn another high interest rate. Then they borrow against that, then they lock it up somewhere else and they earn another high interest rate. So they're out there triple leveraged, earning some pretty good interest if the token retains its value and there's no market crash. So it all goes good while the waters are smooth. So let's see what Celsius is. So that's decentralized finance. Now, centralized finance is things like Celsius, BlockFi, and Nexo. And you lock it over and you lock your collateral up on a platform like Celsius, which I did. And I did to get a down payment on a car. And, I paid a very small interest rate, but I was able to get a good down payment on a car and make my car payment really low because I was able to put down a significant amount. I hawked up a bunch of Chainlink and I put it on Celsius and I borrowed $4,000, so, hey, and I was able to pay that back with no problem and everything went smoothly. That was over a year ago, and that was almost 2 years ago. But since then, Celsius has had some issues. I saw warning signs of this, I guess, mid last year. I saw Alex Mashinsky, the CEO, like personally attacking Zach Prince all over Twitter. Zach Prince is the CEO of BlockFi. Now, I'm not going to sit here and be, a judge of character, but I kind of am, but what CEO really has the time to come out of their castle to go like personally attack their competitor and be like, meh, 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 like, and bitch all over Twitter about their competitors and talking smack and stuff like that? Like, if I'm going to have my money invested in something, I want that CEO to have his or her head down working and working to make the company the best that it can be. I don't want to see them in some kind of pissing match with some other CEO. And the other CEO, Zach Prince, he didn't even really respond. Like, he's like, all right, dude, whatever. Like, I'm over here just trying to keep my company doing good. And I respected that. So he did not feed into Alex Mashinsky's BS. Well, that was my first sign that I was just like, I don't really like this or endorse this type of behavior. So I pulled my money. I paid back that car deposit loan, and I got my chain link back, and I pulled everything out of Celsius. Like, I just wasn't feeling good. And then not too long after that, New York State or New York City, I can't remember which one. New York starts to crack down on and starts regulating on Celsius, and they discontinued the ability for the people who have their money earning interest in Celsius to earn interest on it in the United States. And that was another bad sign for Celsius. And then now we had the Terra incident where Terra went into the toilet. And a lot of stuff, like I said, have been set off due to that. So Terra was a major institutional pillar in the crypto space. Celsius has been a major institutional pillar in the crypto space. And so now I think that Celsius had a lot of money hypothecated in the Terra ecosystem, so they lost a lot of stuff. But this article here in Altcoin Buzz will go through some of this. So what is rehypothecation? So Altcoin Buzz starts with that. It's important for you to understand this term if we want to get to the bottom of what's going on with Celsius. When you deposit your Ethereum and earn 6% or USDC to earn 7.1%, what do you think Celsius does with that Ethereum? So you could deposit, I had my Chainlink and Bitcoin deposited in Celsius for a while, and some Ethereum as well. And I was earning, about 4 to 8%, roughly. And I was getting my weekly, every Monday driving to work, I would get a notification on my phone saying, I earned like $50 a week. Man, it was going smooth sailing for a while. So what do you think Celsius does with that collateral? Do they just sit on it and keep it in your account for you? Like all investment companies that work with deposits, like banks or otherwise, they need to make money on that money to pay you interest. In banking, the term for this is net interest margin. That's a key word, where they charge 5% for a loan and they give you 1% in interest. That 4% difference is the net interest margin, and it is one of the most important ratios in KPIs, key performance indicators, in the banking industry. So one of the things that I was bragging on about Celsius before was, a traditional bank like Wells Fargo or Chase, you'll get 0.1 interest rate at best on your savings. The high yield is maybe a 0.5 or 1%. Oh my God, what are you going to do with that 1% on your savings? So it made the crypto banks, centralized finance banks like Celsius and BlockFi and Nexo really appealing, because you could get at a minimum 4% on what you've locked up in savings. And if you just want to do stable coins like USDC, it's equal to $1. So there's no risk of it losing value, right? And so, but what they're doing is they're rehypothecating what your collateral that you've put in there. So they are taking that and they are going and lending it out on other platforms. They're getting a higher interest rate by yield farming on that, by putting it into even higher deposit, higher risk, DeFi platforms and all types of other platforms. And then they're getting that net interest margin. So you might be getting 8%, they might be getting 20%. And so the net interest margin is 12% that they're receiving. So so how Celsius hypothecation practices can make your crypto go poof. Say a hedge fund wants to lever up their 10,000 ETH position, currently priced at say 3,000 per ETH. Interesting. Okay. And Celsius is, so this article continues, and Celsius is doing that too. Now it's not just them; the other leading CeFi lenders like BlockFi and Nexo do it too. So DeFi platforms do not do this. Aave does not do this. Maker DAO does not do this. Yearn Finance does not do this. When you lock it up, it stays locked there. Okay, so in lending operations, so the CeFi platforms like Celsius, BlockFi, and Nexo, they're not really that much different than what traditional banks are doing, with their fractional reserve banking. So, and if lending operations of centralized exchanges like Binance do it too. It's a common practice and it's not illegal. And if done honestly and transparency, it's not unethical either. But it's rarely done transparently. And that's the beauty of DeFi and the blockchain, because all that is transparent. You can see what's going on. So rehypothecation is when Celsius or other lenders are lending out your collateral to make money. But again, that's oversimplistic. What if a company decided to borrow money and lend that out too, along with your collateral? Now we have a company that is operating as a fractional reserve, like a legacy bank. And a fractional reserve is, a bank really only has to keep 10% of your deposit at a time in their vaults. So if you deposit in $1,000, they only have to keep $100 in their bank, and they can go out and play with, gamble with that other $900. And that's what legacy banks do. And that's what we've been trying to get away from, and that's dangerous, because a loan and investment losses are not just losses for the company, but they could mean the loss of your collateral too. So if you got a home equity loan and, they used your home to sit there and gamble with it, then rehypothecate it, and there's something happened, and then they lose your collateral. So, or if they sit there and take your Bitcoin or your Ethereum and they use it to put it into other DeFi platforms, and say that DeFi platform gets hacked or loses their keys, then that is gone, and they have to figure out how to pay you back from that. And in a lot of cases, they can't. Okay, so because loan and investment losses are not just losses for the company, but they could mean that the loss for your collateral too. The collateral that you thought was safe, by the way. This helps keep the price of Bitcoin, Ethereum, Litecoin, and other blue chip projects that have been around for a long time. Okay. So now with rehypothecation, we're starting to understand what the problem is, or at least what the problem could be. So let's take some of the recent facts about Celsius. So fact one, Celsius lost 35,000 Ethereum on Stakehound. And this is a time when Ethereum was worth about $3,000, right? Here's a tweet. We are the first to report that Celsius Network lost at least 35,000 Ether in the Stakehound key loss. So Stakehound is a staking platform like Rocket Pool, like Lido, where you can lock up your Ethereum and stake it and earn interest. And Okay, so Stakehound lost the keys. They lost their private keys. That's a big no-no in the crypto space. You have your public key and your private key. That's what gives you financial autonomy, is the fact that you have to be responsible for that. And banks, they take advantage of the fact that people just want to be mindless drones and not take their own financial responsibility. And that's why we have the low interest rates and all the constant fees and abuse in the credit system that banks give us. And that's why crypto has come about, because of the abuse and the gaslighting and everything else that banks have done to the general populace. And so people have created crypto to try to get around that. Okay, but there is the personal responsibility of having to hold on to your private keys. And if you lose those private keys as an individual or as an institution, you lose all your money. There's no turning back around. So Stakehound lost at least 35,000. Celsius Network lost at least 35,000 Ethereum in the Stakehound key loss debacle back in May 2021. So Celsius is bag holding over 42,000 Stakehound staked ETH in verified wallets. So the staked ETH is the token that you get back in exchange for locking up your collateral. And so the staked token is a representation of your collateral. And that can be worth something. You can trade it on the open market, but when things get out of balance, the value of that stake token can go down. So don't get me wrong here. Stakehound and or its custodian Fireblocks have mismanaged the keys, and now Stakehound's staked ETH is now worth only a fraction of what staked ETH should be worth. So that staked ETH token is now pointing to lost Ethereum. So there's no Ethereum there for that staked ETH. So it throws the staked ETH and the Ethereum out of balance. So there's a lawsuit going on about it, but it's still Celsius' problem. So Celsius can't say, well, it's Stakehound's fault. That's not us. They're still in charge of what the decision they made to lock up that Ethereum and earn interest on Stakehound. And then fact number 2, okay? So that was one thing that is caused problems in Celsius. Fact number 2, they lost $50 million in the Badger DAO hack in December. This one they finally admitted after the founder and CEO Alex Mashinsky was confronted in public during an AMA about it. Etherscan shows that $51 million was lost in that hack. How is Celsius gonna pay back if people try to claim their money on some a smart contract exploit, right? And then fact number 3, Celsius has 288,000 ETH staked in the ETH 2.0 contract. Now that's not a bad thing, but because we have the merge coming, the Ethereum 1.0 2.0 merge, even though I'm not supposed to say 1.0 2.0 anymore or whatever. And that's Ethereum moving from proof of work to proof of stake. And the more I learn about proof of stake and proof of work, the less I'm actually enthused about it. But that's for another episode. But here's the thing. The merge hasn't happened yet, and we have no idea when it will, despite what everyone tells you. And while we wait, that deposited Ether earns 0. And we've seen numbers saying this 288,000 represents 22% of their total ETH holdings. But we believe it's a smaller percentage of this, but still do the math. So a lot of their Ethereum is locked up in the ETH 2.0 contract. They cannot redeem that. All they have is just the token that represents the staked ETH token. And so when that staked ETH token gets thrown out of balance by things like a Stakehound, key loss and stuff like that, and then the value of that staked ETH is not worth as much, and they have all that Ethereum locked up on the ETH 2.0 contract, and they can't get it out to help rebalance that, then there's a problem. And then what if customers like now during this downward spiral are all trying to take their money off and redeem their Ethereum, and Celsius doesn't have it? Okay, so so fact number 4. So just those previous facts, they've lost up to $120 million worth of Ethereum. Between those smart contract exploits and the value loss and stuff like that. So fact number 4, they're raising money in a terrible environment. Celsius is trying to fund their mining operations, but trying to do so now feels like a desperate move. Major competitor BlockFi is raising a down round. A down round is a big deal. It means they're raising money at lower valuations than the last time they raised money, which means the company is giving away more equity for the same dollars. Anyway, so yeah. In fact 5, Celsius lacks liquidity that they have to borrow to customer. Celsius lacks the liquidity that they have to borrow to pay customer redemptions. So I highlighted this here. We have verified again, thanks to Etherscan. That's the blockchain explorer. So you can see everything that's happening on the blockchain. That's transparent. That Celsius is borrowing to pay customer redemptions. So when I paid back my loan, when I pulled all my stuff off of Celsius after I saw what Alex Mashinsky's behavior on Twitter, I went and I did a transfer. I transferred out of Celsius. That with DeFi, that automatically triggers the smart contract, and everything is completely automatic, and the money's there. You can see it on chain. With CeFi, I had to put in a request to redeem my money back and to pull my money out of that savings account, just like I would a bank. And they have to, it takes about 24 to 48 hours to process, and then they send it and they transfer it to my wallet. Well, if they don't have the money, looks here again, thanks to Etherscan, Celsius is borrowing to pay customer redemptions. Over $90 million in the last 30 days in the top two stablecoins, Tether and USDC. So unlike most of these where the company refuses to respond, Mashinsky has some strong words about it. He says that Cell manages interest rate risk by borrowing when rates are low like now and lending more when the rates are higher. He sees this as normal collateral management. But anyway, Celsius has not had the money between the Tether incident and between losing all this Ethereum on DeFi, on hacks, and on the staking platform losing their keys, and then the ETH platform having their Ethereum locked up while staked ETH loses its value. I mean, there's just a lot of things combined that are really making Celsius go insolvent, and this is a problem, man. So this is scary stuff. But like I said, we are early in the crypto space, and I will just go ahead and conclude it because I'm at 30 minutes. But all this stuff is experimental, and I'm passionate about the opportunity and the freedom that all this stuff is, but I'm also very aware of the risks that this is taking and the battle, the financial war, the soft war, as Jason Lowry, the Bitcoiner, likes to call it, that is going on between the financial institutions and the people struggling and striving for independence and freedom and autonomy. So, and I've lost my ass in a lot of ways, including the job, the dream job that I got, but I'm still going to chug along, and I'm still going to keep trying. I'm going to still keep working and still try to keep increasing, my value through my skills and my higher ability. And, if I can, grow this show, that would be great. So if you haven't subscribed or give a thumbs up, please do so. It helps in every way. I'm not going to sit here and try to bum money with this show. This show is my sandbox. It's my message in a bottle to try to get things out there and put positive things out there in the world. So, anyway, that being said, I just wanted to talk a little bit about what was going on with Celsius. I have a lot more stuff to talk about every single day now. So I'll see you guys tomorrow, man. We'll hopefully we'll see what happens in the crypto market. Things probably won't honestly be getting better anytime soon, but we'll figure that out together, right? All right, man. Later.
Thank you for making it to the end of this program. If you actually like this content, give a thumbs up. And if you want to hear more, just hit the subscribe button. I'm available on YouTube, Odyssey, and BitChute, and on all the major podcasting platforms in audio version. Spotify specifically. If you would like to follow and leave a review, that would help a lot. I am also available on Twitter at EurekaJohn1. That's EUREKA John, JOHN, and the number 1. My DMs are always open. Feel free to shoot me a message. Thanks again.